Welcome back to the Deal Mastery Insider. Today, I've pulled up a listing that I want to unpack, and I think this one is fun to look at for a couple of reasons. I was just browsing around on the Transworld website, and this one caught my eye mostly because of the title, Value, Value, Value. Well, let's unpack this and see if, in fact, this deal really does have a lot of embedded value or not. So this is a sewing machine quilting and embroidery business located in Tennessee. And the business is, they're asking $1.115 million on $225K of seller's discretionary earnings. They say here that they have $500K of inventory. They say here the retail value of the inventory is over $1 million, which is maybe interesting. I'd want to unpack that to see if there really is some embedded value here, and we'll talk about how that might play into the deal dynamics in a second as well. But, a couple other little tidbits here. It looks like when the owner wasn't running it, at some point her husband ran the shop for a little while. But they also claim to have a bit of an e-commerce presence, though if they're doing $900K of total revenue, they can't have that much of a presence. And there's 6 total employees. The business was established in 2010. So to me, this is a really interesting deal. And I think it illustrates the challenge with massively overpricing, especially a really small business listing. And so I busted out my trusty Excel model here to take a look at this. And I wanted to just walk through some of this math with you guys really quickly to give you a sense of how I would evaluate a deal like this. So for starters, we've got the sewing store. They're doing $225K of EBITDA. In this case, it's technically SDE, but who's counting? I sort of hard keyed this, but basically asking for just a hair under a 5x multiple, which is about a $1.1 million purchase price. If we assume total transaction expenses of about $50,000, the total deal size would be 1.16 million or so. Sorry, I had to adjust one of my formulas really quickly. If we assume a 90% SBA loan, which is about $1.05 million on a $1.165 million transaction size, we would need about $115,000 to buy this business. And I'll illustrate to you pretty quickly here why that's substantially overvalued. For starters, if we just look at, this is a chart of seller's discretionary earnings by size and a low, mean, and high multiples across these different sizes. So you can see here, based on market data, a 250K SDE business at the midpoint, assuming it was kind of middle of the road, would trade at about a 2x multiple. A great one would trade at a 3x, and a low one would trade at a 1.2x. And they're asking for just under 5x. So they are well above, effectively more than double the mean, and even almost double the high watermark here. So substantially overpriced. And I'll show you why that matters and why a small business buyer would be borderline ludicrous to take on this deal. And it's pretty simple if you think about it. So SBA loan rates have come down a little bit, but maybe 10.5%, 11% is a reasonably conservative assumption for where the rate might price today. You could even go up to 11 if you wanted to be really conservative, but we'll leave it at 10.5 and give them a little bit of credit. Average SBA amortization is 10 years. And so if we have a 10.5% loan for 10 years and the loan balance is $1.05 million right here, our annual payments on that loan will be about $170,000 a year. The business makes $225K a year. So basically, we could put up $115K, could buy this business, and we'll make $225,000 a year. We'll pay $175 in debt service, and then we'll ultimately have a remaining cash flow of about $50K a year, which on the invested balance is, that's like a 50% return on invested capital. 48% return on invested capital is not actually terrible, but that's not really giving you the full picture. And the reason is simple. If you were to take out $1 million plus personally guaranteed loan, we're putting up your house, all of these different things, to earn an income stream of $56,000 a year, that would be insane, right? You could go get a job making $50,000, $60,000, $75,000, $100,000 a year without taking any $1 million loans out and not putting your house at risk, doing any of those things. And you would be making more money for not having to put up 100K, not having to take out $1 million loan, and not having your house or your personal well-being or your net worth on the line. And so no rational person is going to do that. And for a business like this, where the whole business is a 6-employee owner-operator quilting store, nobody is going to take that risk on. You would be insane to take out $1 million of risk to make 50K a year after debt service, right? You could get a higher paying job than that without taking any of that risk. And so that's why, coming back to this chart, these businesses typically trade for much lower multiples, because the risk necessary needs to be commensurate with the cash flow that you're going to make. And this is definitely not the kind of business. You can even see here that the owner's husband had to step in and run the store when the owner was unable to. This is not the kind of business that you can buy, put a manager in, and passively operate it. In fact, if you were to do that, the most you could pay your manager without losing money would be 50 grand a year, right? You're probably going to need to pay somebody 75 or 100 to even think about stepping in and operating this business. So this deal is substantially overvalued. The only thing that makes this potentially interesting is the alleged retail value of their inventory, which is in excess, in theory, of the purchase price, right? So maybe there's an angle there. Ultimately, I still don't think the financial risk of the purchase remotely ties out from a risk standpoint with a purchase price anywhere close to this. I think a more realistic purchase price would probably be based on our market multiples here, maybe 2 times SDE, which would be about 500K or 450K, something like that. And so I think their expectations are super high. And if we think about kind of going a little bit more into the weeds around some of the risk here, the question of whether or not this business should trade at a midpoint multiple, a high multiple, or a low multiple also becomes really relevant. So even in a best case scenario, this business is probably worth 750 grand. But the question I would have for you is, if you're evaluating a business and it is a retail quilt store with 6 total employees, right? Think about retail. Typically a pretty risky business model. They're selling products that they likely don't own and manufacture themselves, which means they're probably available for sale on either the manufacturer's website or places like Amazon, or sewing and embroidery wholesale websites that are out there in the marketplace already. And so you're competing directly against e-commerce as a major competitive driver of the business. And it's a tiny little owner-operator business that seems to be highly reliant on the owner and or their family members to even run. So you're basically buying yourself a job, right? So to me, if I come back to this chart, it's not a business that operates without the owner. It's a business that has substantial risk for things like e-commerce. It's in the retail sector. I would probably price it on the lower end. I don't think it's even earning a midpoint, definitely not a high point multiple. So to me, this math is just a really good illustration of why businesses like this should never be priced this high. Nobody is going to take that amount of risk to buy this business. So that comes back to the last question here. And by the way, value. I don't think so, right? But that comes back to the last question here, which is, okay, well, what about the fact that they have $1.1 million of inventory? How should we be thinking about that? Well, that's the retail value. If you had to liquidate it, right, it would probably sell for something close or less than this number, which is their cost basis in the inventory. And in that case, that's getting pretty close to what I think a realistic purchase price actually is. But if the owner was totally stuck on this retail inventory value being a big barrier to getting the deal closed, I would look at something like consigning the inventory and saying, hey, you know what? You keep ownership of the inventory and I'll pay you for it as I sell it through. That way, that removes the inventory as an anchor factor for the valuation. The other way you could look at the deal is, instead of looking at an SBA loan, you could try to get an asset-based loan based on this inventory value, but they're probably not going to give you credit for the retail value. If anything, they'd probably come closer to the cost basis, or really the term they'll typically use is what they call the net orderly liquidation value of the inventory, which would probably be at or below this number as opposed to what the retail sales value of the inventory is. So those are a few considerations as we look at this value sewing business. I don't think the value is actually there. Curious what you think about it. Would love to hear your thoughts. And thanks for tuning in to the Deal Mastery Insider.